Hello, welcome back to WINFX Trading YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. If this is your first time of visiting this channel, do your best to subscribe and turn on the bell notification so you get notified each time I upload a new content, and try to like, comment, refer your network to this channel so that YouTube push us to a high level of audience. In today's video, we shall talk about how to position for long-term on Deriv new volatility assets. Volatility 151S and Volatility 251S. These are the new volatility indices that Deriv just introduced, and one thing with introduction of new asset by Deriv is that they tend to push such assets in one direction over a long period of time. Right now, one thing is, how do you position? Which direction are you looking at? You see, let's assume that they just released this asset about a month ago. Now, if we go to the monthly time frame, can we justify that? Okay, we saw 2 months candle. They launched it a couple of 2 months ago, and these prices were created. We see a market that dropped from a price of $176,955 and currently running to a price of $100,170 something thousand. $101,700 something. Okay, if you calculate the pip difference, like the differentials here, it has covered over, I think, over 82,000 pips in a couple of 2 months. Okay, now if you're actually going to position long, you are going to position long in the direction of the move, like the monthly move. Look, the month right now, we haven't seen any bullish monthly candle. They are all bearish. This December, the December monthly candle is still bearish. So if you really want to position, make sure you position to sell, and you can see such signal in the H4 time frame or in the daily time frame. You notice a market that is actually making big impulsive move in the downtrend direction after certain break of structure. So we see a market that actually break here without any retest. It didn't give us any retest at all. But if we can go to H4, we can see the mechanics in this market, the dynamics in this market. We see a market that breaks structure but with no retracement. It will break structure with no much retracement, and it will impulse and create another structure and break. If you are looking for staying long, because I believe that this market will be driven to a price less than 100,000. So if you want to stay long, I think you have to start looking for entries near this zone. Anything here, you don't need to put stop loss. Just you can deposit $200 and then risk the money, or you can deposit $500, risk it, open certain position and control your margin. Trust me, the price is gonna go down more, because that is the secret of Deriv. Once they launch a new asset, they tend to drive it in one direction so that you will be psychologically down, because the only way a broker can make you lose is to put a psychological feeling that this market has gone in this direction so much, so it's supposed to buy, or it's supposed to sell. Like, it's going so much in one direction, so let's reverse it. While doing that, the broker will keep pushing it in their own direction, in that fixed direction, and you keep losing. No matter how you stage for such assets, you will never see profit. Okay, if we check volatility 250 index, This is Volatility 250 index. Is a new index as the same way 150 is a new index. So if you go to the monthly, we see a market that have 2 monthly candles, and then if you study the first candle, it has wicks on the upper and lower parts of the candle, like the upper wick, or the this upper wick is the bearish wick and the bullish wick. You notice that these wicks are very lengthy, so the market ranges near this high or near this low. Now we see that the other monthly candle that became bullish and rises to the open of the first candle. It rises up to the opening of first candle and starts dropping near the it's just below the midpoint of the previous candle right now. So it's getting below the midpoint of the previous candle, and when you look at this scenario, it shows that this market is going to sell. They are going to drive this market to a price of less than $200,000, or from $200,000 down to $100,000. Trust me, all you need to do is to look at the daily time frame. If you look at the daily time frame, you see what the market is doing, that the market actually respects this structure here that was broken impulsively. This structure was actually broken. You see, when you are staying long in a market, you don't need to put stop loss. You just bring a certain APT and risk it. If you lose, no problem, but you can't lose because you're actually following the right direction the broker is going to push the market. You see how impulsively this market actually break after some small ranges or distribution. If you check well, there were weak rejections. Here. There were weak rejections here. Okay. There were weak rejections here, and then we see a retest and then an impulsive move. See the impulsive move. Now there is another retest. The impulsive move actually started from here and then impulse down to here. So this market have actually reacted to a price of $146,000 plus, and right now it retracted to a structure that it break. Now if you want to enter this trade, I think you will be looking at placing an order at this place. You can place a sell limit order here. You don't use stop loss. You don't need to use stop loss in this type of trading because you are staying long. You don't want to be taken out, so you have to do your calculations so that no matter how the market goes against you, you still remain in that market. So you see what is happening here. If you go to H4, you see that this market finds it difficult to go up. Like, it's not going up, it's finding it difficult to go up. Rather, it is going down. They are going to drive this price downwards. Okay, you see a market that actually have a Z pattern, but the overall direction of that Z pattern is downtrend. Because if you look at it very well, if you are going to connect any of these points along the Z, if you are going to connect any of the points, then you notice the slope of those points is negative, that is downwards. Now we expect this market to give us an impulsive move. So if you have I think if this market drive itself down to 100, let's say 150, or even if it drive itself near 146,000, you must have gained 75,000 pip. If you have a $200 account, for instance, I just, for people that have low capital, or you have $500, let's assume $500 account, and you are targeting 750,000 pips, and you use 0.1, that is $7,500. Now, your belief is that this market cannot saturate your $500 before it starts impulsing in your direction. That's your belief. Now, our fear is, what if the market get back to this price, which will be around 58,000 people? That is one of the biggest fear. In that case, you can now say, okay, we have 58,000. About 58,000 times 0.1. So your equity is less than, it can't hold this trade. Then if you use a lot size of 0.05, it's still 0.02, it can still not hold the trade. Then if you use 0.01, this is 0.01 will cost us $580. You can still not hold the trade. Now, what you need to do is you place order. You can't just start trading anyhow. You can place order near the midpoint, so that you can place order near the midpoint of this part, somewhere here. If you place order here, then you'll be afraid of this. You'll be afraid of that 2,000 pips plus. In other words, you can easily risk 0.01, that is $320, and like you can risk it on $500 account and hold this trade, hold it for long. You hold it for long. Maybe you enter there and you hold it for long, and the market, like the asset, drive itself to a price of 100,000 pips. If it drive itself to a price of 100,000 pips, I think you will expect over 150,000 pips. So when you have 150,000 pips times 0.01, that is $15,000 plus. Now, you can use a system called feedback. If you notice that your equity is going down, you can add extra $500. It will build the equity. Then you add a new position, because then the price is giving you more opportunity. If the price is creating opportunity, you feedback more money. Let's say you put, each time there is a gain in opportunity, you add extra $500. Each time there is a gain in opportunity, add extra $500. Meaning that there is probability of getting $1,500 per position, and you can get some feedback up to 3 times, and your capital is there, your equity is there, and you have gained $4,500 throughout the period of the drive. This strategy is very, very good when it comes to Deriv, because the way they drive price, most time they drive it in one direction, the you will be psychologically down, and you start to reverse the market, and that is where you will never make it. Okay, thank you. Make sure you take advantage of this new volatility indices and build your wealth. But then if you still find it difficult, and maybe this system of trading is not good for you, we produce a VIP signals on daily basis, up to 3 signals and beyond. Like, we have at least 3 signals per day, and these signals are 100% winning, both synthetic, both Forex. You have to change your life. Also, you can enroll for our courses. 2023, we are coming with Boom and Crash Millionaire course. You have to change your life. You have to leverage the effort of the expert and become rich. Okay, thank you. Bye for now.